What's going on, everybody? 360 Digital Closing Bell here for our weekly Look Ahead podcast. I am your humble correspondent, Michael Tanner, coming to you live Sunday morning from an undisclosed location here in Denver, Colorado. As always, I am joined by the executive producer and publisher and director of Oil and Gas 360, Stuart Turley. How you doing, man? You're coming live from an undisclosed location in Dallas. How's the weather out there?
Absolutely beautiful. It's a great day for a bike ride.
It is beautiful. It's beautiful here too. A little overcast. I was up early this morning putting together this outline. We have a wild show for you guys lined up, and we will get this in your inbox Monday, April 27th before the market opens. So look for this to drop later tonight or tomorrow morning if you're listening. And then we have, like I said, an insane show lined up. We're going to talk about storage and what that really means from a trader's perspective and some of my thoughts on that going forward. We have a week ahead in oil trading is going to be amazing. We have all the stories. We're going to cover the levels, the commitment of traders. We're going to go to the news desk with Stu. I mean, how much can you show people how many papers you have sitting on your desk? This is how much news, if you're watching on iTunes, or excuse me, not iTunes. No one's watching on iTunes. You're listening on iTunes and Spotify, which we really appreciate. But if you're watching on YouTube, Stu is waving around thousands of papers. It's unbelievable. We have so much. We're going to get our picks for the week. And then if you are listening on iTunes and Spotify, we are going to give Nick and Steven a call for an iTunes exclusive. Before we get going, though, we need to do some quick clerical work. Please. If you're not subscribed to the show on iTunes, Spotify, YouTube, do that now. Pause the show, subscribe, resubscribe. Do whatever makes the algorithms go nuts. We really appreciate all the people who have reached out to us that they've enjoyed listening to the show so far. If you don't follow Entercom on Twitter, please do that. We're about to revamp that here very soon. Trust me, you're going to want to following Entercom if you are in the EFT community on Twitter, LinkedIn, Oil and Gas 360, Entercom. Connect with me, Michael Tanner. Connect with Stuart Turley. We have so many great videos coming out for the Energy 360 Network. On Friday, Stu just launched 10X Technologies in our interview with Miguel Pena, which was awesome. On Monday, as you're listening to this, we will be dropping an exclusive interview you can't hear anywhere else with Adamantine Energy Principal Tisha Schuler. It drops, like I said, today. She is an awesome person. I love every time I get a chat with her. She's a specialist in ESG and one of the top ESG consultants, and somebody that if you're an oil and gas company, you should think about working with today because she is one of the best when it comes to outlining and strategizing how your company should move forward in this ESG world. We will be dropping that Monday. Gregory Whitestone, we have an interview with him that's dropping Tuesday. You should stay tuned to that. He's a former geologist turned climate scientist now that sells I Love CO2 bumper stickers. It was a wild interview.
You know, that was a lot of fun when I met.
Was.
Cat scratch fever. You know, do you remember that one?
Yes.
Oh yeah, old Ted Nugent. He was fantastic. He was one of the nicest guys on the planet. You know what his bumper sticker was?
I love CO2.
No, I love animals.
Oh, okay. Oh, I see. Okay, sorry. I thought we were talking about Gregory Rice over saying you, but he is an awesome. It's a great interview, and really he comes with, you know, his book titled Inconvenient Facts really does that. Just lays out sort of the facts behind climate science. And then on Wednesday we're going to drop an exclusive interview with Squirrel. This was just awesome. There are so many cool nuggets. I'll tell you one thing I learned from there that will tell you guys if you're listeners to the podcast, you get an early exclusive to this. One thing that was mentioned by one of their analysts, and this was the most interesting thing I took out of this interview. And I've been telling a couple people this weekend, Stu. I've been telling them, don't tell them who it's from, but I've been dropping this, is that traffic congestion up 3% last 2 weeks. That's good to hear if we're talking about demand coming back. We see traffic congestion already going up. That is a really, really good early sign that hopefully some of this demand stuff is coming out.
That was great. Just finding that out in the interview. Well done. That was great.
Yeah, no, it was awesome, and that's really good to hear. It's sort of, you know, my theory is we're going to have a reverse quarantine, and the demand is going to snap back much quicker than I think it died. But then again, that's just my guess. All right, that's enough of the intro stuff. I want to shift gears to Cushing and really this storage issue from a trader's perspective. By now, we spent Thursday's show talking about what negative pricing means, what the storage game is. If you haven't listened to that, moral of the story, storage is the name of the game right now. And it's not that it's not available. It's just that it's all rented out. Currently, there's about 2 to 4 weeks left of storage available at the current inflow rates. And the reason why prices flipped negative was because everything at Cushing was booked out. And as our friend David Forsberg mentioned in that article that you can check out either on LinkedIn, I think Stu, we published that out on Oil and Gas 360, and you can also view it on his website. I highly recommend you check out his blog and sign up for his newsletter. So so much great stuff involving the energy tech stuff. But what he talked about was prices really aren't zero. Oil and gas marketing companies are still buying oil at a above zero cost. You can go to any, just Google oil and gas marketing and refining company. Specific, I can link to a couple of I should start linking to a couple of these in the show notes, so you guys can get an idea of what oil and gas companies are actually getting for their oil. He mentioned in his specific article that, companies were getting an average of about $15 a barrel for the February to March, which, is actually a decent number when you consider we saw a negative 37 settlement. But what is, I'm getting a lot of people say, can we get that? We get prices are negative because Cushing is booked. One, I've been getting from people, how do we get involved in this? And my answer is very simple. Don't. Stay far away from this. I'm not even playing this game for a lot of reasons. One of them being physical delivery of oil is its own ball game. I know there's a joke that you're going to have 10,000 barrels show up at your front door. No. It's more like you're going to, one, have a margin call because your broker actually doesn't know how to take physical delivery of oil. That's the secret sauce, not the secret sauce, but that's sort of something that a lot of people don't think about. Oh, I'm just going to go buy oil and take delivery of it. I'm just going to sign up for my local futures bro. Yeah, that dude probably is not taking physical delivery of oil. Not quite how it works. So you're now stuck with a margin call of, you're looking at $15 a barrel, or, you're stuck with a margin call now we don't even need to get there. Do not do that. So that's the first thing I've been getting. The second thing is what does this just mean for the industry trading as a whole? And really it just gets down to the mechanics of how the WTI future swap options contract is traded. Because this is where those contracts are settled, it's used for two things. One, Cushing is the settlement point for these options, like I mentioned. So that's one mechanics of it. The second is this is the contract that's used to hedge, which means that in 2 to 4 weeks, which some of the estimates put, they're going to be full. You see some people, I think most people are at 4 weeks. It gets full. I've seen some as low as 2 weeks, Stu. I don't know what the numbers on your side are saying in terms of actually when Cushing's going to be full, but it's a 2 to 4 week timeline, correct?
Oh, absolutely. In fact, it was, I was going to say 16 days is a number I saw.
Yeah, and that's just over 2 weeks. So,
yeah. So,
but because of that, this same mechanics could happen again. And to give you an idea, because it's used as a settlement point, and these are the contracts used to hedge, the unintended consequences that come out of this could arise squarely. And yes, this is what, and what I mean by hedges is most oil and gas operators use the WTI futures and options contracts, specifically the futures options, to hedge oil production. And if, the light bulb just went off, it's going off for a lot of people. Well, what if you're an oil and gas operator that only exclusively produces, let's say, Wattenberg oil, the extraction oil and gas, a public oil and gas company here in Denver that exclusively drills in the Wattenberg, or AKA my pick for the week, Bonanza Creek, only produces onshore Wattenberg oil. Well, they're using WTI and the Cushing settlement to hedge their production. And up until today, it's worked fabulously. You didn't have to worry about, I'm producing this oil, but it's settled here, it's fine. Well, now we're getting into the idea of hypothetically this insane contango market can really screw up your hedges. And there's an example that I think paints the clearest picture. It's from the reserve report, and it's got by a guy named Matthew Serrett. This is probably the best oil trading newsletter on the planet. Partly why I'm probably not going to get into the newsletter game, because this guy's already doing it insanely well. He gives you 2 articles a week. He does not spam you. I promise you. Go to reservereport.substack.com. Sign up for his newsletter. This is a shameless plug. I've only chatted with the guy once on the phone, but it's an insanely good newsletter, and I'd highly recommend everybody who listens to this podcast should sign up for it. So he gives the example of the average 3-way collar hedge with the subfloor at 25 using these WTI puts and calls, which in this environment, we can agree to disagree. I hate 3-way collars. Some people love them. But imagine this hypothetical situation that arises because of this situation, that you've producing local oil at $25 a barrel, but your WTI futures contract that you are trading is hedged, and because storage is unavailable at Cushing, they're trading at $15. That subfloor you bought would unexpectedly cost you now $10 extra a barrel, even though you're selling your production at and not below the subfloor price. I'm dead serious. That's why do you think I don't like three-way callers? Right there, people. And a little behind the curtain, you want to see, you want to know why Parsley and Matt Gallagher is all for shutting in production? Right there. They have three-way callers. I should point at the screen. Right there. I'm pointing at one of my screens. Right there. It's because they have three-way. I mean, look at this. Every barrel of oil you produce, you're going to be paying $10 for. Of course they want to shut in. He wants to shut in everything he's got. Turn off the taps. Let's let oil price rise back up to $50. And it's just unbelievable. And this is honestly an unintended consequence that no one has ever had to think about until now, because up until now, storage has really never been an issue. We've never even gotten close to even considering that Cushing would be full. It just never would have happened before. And so the key takeaway from this is I think what you're going to see happen is the WTI settlement at Cushing is going to be offered elsewhere. I think you're going to see other settlement hubs around the country that become to mimic more of that local oil. I mean, if you go to, for example, one of the price bulletins I use is Plains Marketing and Company. It's the same one that actually David Forsberg referenced in his article. They they have 65, or it's like 60 different numbers and 60 different blends. Oklahoma sour, Texas onshore north. I mean, and we're just talking everyone hedges with WTI settlements. It's honestly crazy. No one's really thought about this. And I'm not saying I'm smarter than everybody. I didn't think about this until really this situation arose, and you start working through the unintended consequences, and you're like, whoa, this is now interesting. So I really think what you're going to see is multiple settlement points start coming up that begin to more mimic the local oil. Natural gas doesn't even do this. The only example me and Stu could find of multiple settlement points for these type of contracts was actually the European natural gas markets. And they've actually tried to implement multiple settlement points throughout Europe and, the UK and Netherlands, but it really hasn't worked out. So it'll be interesting to see if that changes. But really, that's the situation that arises, is you have three-way, and the majority of companies have three-way callers. As much as I hate them, it's like half the companies and that hedge, and it's like the majority of the volume is either swaps or three-way hedge or three-way callers, just because they're cheap. It's cheap insurance. It's the same insurance I have if I were to go get smoked by a car outside right now running. I'd be paying. It's a large sum of money. I wouldn't go into medical debt, thank goodness, but I would definitely have a large bill, and that's basically what a three-way collar is. It's cheap insurance up front to hopefully nothing crazy happens.
Mad at me. Michael, your mom would be very mad at me if I let you go out and play in the street and get smoked. So
she would. But someone could hit me. Someone could drive a car through my door, through my house right now. I'm in a basement. I'd be dead. I'm facing the street right now. I have a nice little window that you could, so all kidding aside, you can sort of now see why the companies that want to shut in, why they want to shut in. This is the situation that they, were realizing a couple weeks ago, and that is now just sort of starting to trickle out with actual negative pricing, is this crazy contango for local oil being sold at one price, which is higher, and then your WTI hedge is trading at lower. So in theory, you should be making money off these hedges, but because you chose a three-way caller, you're not. And all kidding aside, you can kind of go through the list of companies that want proration and don't want proration, and it becomes very clear who's hedged where. So before we move on, that was good to get off my chest. Is there anything, Stu, you have regarding some of this storage and settlement stuff because I'm about ready to put this and stop talking about storage. Yes, it's going to be a big issue. We'll continue to chat, but I have chatted enough about what I think is going on with storage. So I'm going to kind of lock this one and throw this one in the bag. I had 6 leads I wanted to go with today, and we couldn't hit any of them because I needed to get this off my chest.
Phil, you felt the need to rant. And you get the golf. Nice rant, by the way. Thank you.
Thank you. So,
while you were talking about David Forsberg, he is a regular contributor for Oil and Gas 360. Mm-hmm. I just want to give a shout out also to Rare Petro. They talked a lot about a lot of things in their article as well for natural gas that we just put out, and it's already had a lot of reads and a lot of hits. But Rare Petro, being a regular contributor to Oil and Gas 360, had a lot of the similar things on the natural gas side. So just wanted to share that for you.
No, those
And by
guys
the
are
way,
doing great. Those guys are doing great stuff over at Petro, and I'm a little biased. I used to work there, so and I
oh,
started that news poll, so I think it's great. I'm glad we're pushing it, and they've taken it
it,
way better than anything I could have ever imagined. But no, I've
well,
really enjoyed reading their stuff.
cool. Yeah, their stories have been getting some good hits.
Oh yeah, they're the in-depth research. I love how they're linking everything, and they've really created sort of a modern way to view this stuff. Again, partly why I'm not getting. I've considered getting into the newsletter game, but I'm not. I'm slowly pulling the reins off it because there's just so much good stuff out there. And really, what I thought there was a need in the marketplace for was this type of podcast, energy, finance podcast. No one's really doing that, so that's why we chose the podcast medium. And I'm not going to pound you with newsletters every 3 days to
Oh,
get my
Michael, you do
thoughts on
so much
Barstool.
better when you rant. You can't rant on an email.
No.
Okay, you're born to rant.
I appreciate that. And enough, as Stu says, enough of the man love. Let's just get into our stories and our week ahead in oil trading. But again, this is sponsored by Sandstone Capital Group. These guys do insanely good oil research. They provide all the levels from their Energy Glimpse solution. Rumor has it they were going to launch an email newsletter. Maybe now they're not thinking about doing it. Who knows what's going to happen, but I will keep you updated with everything that happens with those guys. I'm telling you, if you want to know what's going on in the energy markets, just reach out to these guys, sandstonecg.com. They actually just relaunching a website, I think next week. They just came up with a new update last week. So much good stuff. Please check them out, sandstonecg.com, for all your energy market consulting needs. All right, so really how I just want to start this is kind of go over the things I'm watching for this upcoming week and just things I want to touch on. And then Stu's got a large amount of international news desk items we need to get to. Really what I'm watching for both this week and as we move to the weeks forward is the USO contract rollover. I know I haven't spent that much time talking about the United States Oil Fund. It's partly because I don't trade ETFs. I stick to the future side of it. So when you talk about how these ETFs are traded, I don't really like them, but it's become a huge issue now in terms of they've now reallocated. Sorry, I just pounded my mic because I'm swinging my arms too much. But it's really become a huge issue now that because how this ETF or this electronic stock, an ETF is basically a stock that you can trade, but that is pricing in other commodities, is they take your ETF money and they invest it in oil futures. So they are the United States Oil Fund is trading oil futures, but if you invest in the United States Oil Fund, it gives you, it allows you exposure to oil price without necessarily buying and selling oil futures. It's become really popular. There's a lot of different ETFs out there. You can get into trading ETFs and do very well. I know a lot of people that do that. But what I'm watching for is the rollover when they're doing the roll now. When the U.S. Oil Fund rolls, that is a huge amount of volume that they are now selling at a lower price and buying at a higher price, creating what we talked about, that forward curve, but really it's a square. And so that's happening May 5th through May 8th. It's probably going to be the most watched USO contract rollover in years. I don't think anything. It'll be interesting to see what effects that have on the market. That ETF was actually halted a few times. I was in a couple trading rooms, and there were some traders freaking out because the USO contract was actually halted. And when you're in a trade, you have no idea what's going on. It's absolutely unbelievable. I have a quick update on the negative mailbox comment. We mentioned in the last podcast that negative pricing, does that mean mineral owners necessarily get negative? Are they now going to get a bill from the oil company? And I did a little diving into mineral rights contracts, and I can't read every single one. Most of them are, they all. Me and Stu could write a mineral agreements contract and get it notarized, and we could say whatever we wanted between us. I mean, as long as it's notarized, it's fair. So this is the example I found was from just the majority of. This is just sort of a cut and dry average mineral contract. Basically, it says the mineral owner bears no cost at any point, and all of the costs are on the producer. I don't necessarily need to read you all of the nutty language in there, but trust me, I will post that to the show notes. So no negative mailbox money. If you own minerals, you're good. You're good. I wonder how many emails I'm involved. I used to be involved with CAMRO, the Colorado Association of Mineral Rights Owners. They're great. They're great people. I'm not on their mailing list anymore. I was wondering if they were pounding people with those. No, don't worry. You're not going to have to get bills in your thing. I wonder how many inbound leads they were getting from that. But that's really all I have I have for upcoming news items. I know, Stu, you have a bunch of international stuff we need to get to.
Oh yeah. Hey, Michael. It's been just internationally. Oil and Gas 360 is really got a substantial amount of international business and traffic. And one of our articles we just put out this morning, Saudi Arabia and Kuwait have already started cutting oil output way ahead of schedule. And they're not even waiting for the date. It's going to be 23% of
Really?
production by May 1, but they're already starting now. Now, that bringing up, you have South Africa just had a stimulus of 500 billion rand, which is $26 billion stimulus package. They cannot
And that
afford
used
that.
26 billion in American dollars.
Yes,
Cool.
but they're financially not able to handle that as well because of the financial problems that they've had with the World Bank. So this is going to go along with a little theme you've got going on here. You got South Africa having that issue. Russia will be slow to recover because it's in trouble.
Mm.
It has got some serious problems, and it is set up. They were set up to run on futures and all of their long-term contracts right now. That's why Putin's not really worried about putting anything or any more slowdowns in, is because of his longer-term contracts.
Well, you said they're
There's
hedged well, didn't you?
Yes, that's it. You just nailed it. So here's the problem, though. He is at almost
Mm.
Venezuelan type structure for his economy. They have so much of their economy is energy based. Now, all that being said, he can survive a little longer, but his total economy is in
I thought you
trouble.
were going to say the S word when you were doing the comparison,
I,
but you didn't,
I did
which
try
is
to.
fine.
I almost
No, but I
did.
did see a news item that Luke Oil, which is one of the biggest Russian operators, $9 to
Yep.
$11, they're comfortable with. That's
Yeah.
crude oil trading at. Whew.
Okay. Uh, Let me throw a number out here that they are comfortable with at natural gas. What number do you think they're comfortable with?
I don't even want to guess. What is it? I make too many predictions on this show. I'll leave this one up to just what
Buck.
is it? Ooh, ooh, and it could be. If you believe, Bernadette and Enverus, which I do, I believe what's coming out, and maybe listen to Sproul, see what they say when that drops Wednesday. But I think they're going to be. That's going to be some green, green, green if really oil gets up there. Because if they can make money at $1, woohoo!
They can make money at $1 and they
Woo.
like it. Okay,
A lot of green. A lot of green.
don't mess with Russia and natural gas. They got it down to a science. Oil, different story.
All right, let's move. I guess now, thank you, Stu. We'll go ahead and move to the levels for the week. Really what I'm seeing is the levels haven't moved much since Thursday, or since the Friday came out on podcast came out on Friday. We recorded that Thursday afternoon. I still see the pivot point 1650. We're trading at 1694 right now. That's where the market ended up closing at. So that pivot point is just really where their largest chunk of volume is. In terms of the levels for the bulls this week, I mean, really, it's a large jump. It's either $18 is your ceiling, or you really think it's going to give up a 20. I mean, if it pops above 18, we don't give investment advice, but I mean, I'm buying large amounts. If we're pop above 18, if we see 18.20 for oil, I think we're going to then see 20 very quickly. There's very little volume. I think it'll slip up there quickly. I think you're going to see hedge funds who are, as we'll talk about in the commitment traders, who are already long, get in long more. So I think 2021 is probably your next ceiling. If we see it slip above 18, 21.03 is your next volume chug, and 22.87, depending on how big of a bull you are. That's kind of your cap. On the bear side, really a lot more volume to the downside. I mean, basically that's because last week we traded on the downside, but even when you look at a 1 month chart, there's a lot of volume to that downside. I think 1649 is probably your first point of resistance, 1473 is your next, and 1377, but really fat chunks of volume. And I think if it continues to stay down in this range, it's going to be very warm. I mean, if you're a price action guy and you're looking at it, if you're trader price action, I would be a bull because there's a bull flag forming right now. You can take a look at that on my charts. I'll have that linked in the video. There's a easy flag. I mean, I think if you're a bull and you trade price action, you should be getting long now because the flag is already developed and that pole is about to go bing, and I'm pointing up if you're listening to the podcast. If you trade order flow like myself, I don't know. I think it's going to hang out here a little longer. So you kind of have that tension between price action and order flow traders. So it'd be very interesting. To give an example, Tomcat, our favorite pick guy, he's a price action guy. So he would be getting, if he traded crude oil, he would be getting long right now because it is a nice bull flag. And really, when we move into the commitment of traders, managed money, while hedge funds aren't trading price action, they're getting long like it's their job, literally like it's their job to get long on oil, because really right now you can't short it. It's tough. Hedge funds trade on a much longer term than some of these really high execution traders when it comes to the futures, and they're not getting in and out. They're buying and holding, and there's only about 50, maybe 100 firms that do this. So I mean, you see that breakdown between 50 traders on the long, about 56 on the short side. Really, that contract on the hedge fund side increased 28,000. Their shorts got eaten by or dropped by 22,000. That's shorts getting closed out. Those are people that have been short and they're cashing in their insurance. That's why you're seeing a huge sell. And what do you do when price bottoms out? Well, if price bottoms out and you're getting paid in your insurance, any smart hedge fund manager just gets long. It can't go any lower. I've already been shorting this market for a while. I've already made a tremendous amount of cash. I'm just going to turn around and now get long. I mean, oil was trading it. You could have picked up some contracts for like $6. I mean, so these guys were getting long all week. Remember, this is last Tuesday to Tuesday. So we had the negative price in this. So Monday, so this takes into account what happened Monday. I wonder how many people got long. And I actually saw a funny story. Carl Icahn's trading firm tried to actually take delivery of like 1 million, 2 million barrels. Couldn't make it happen. So it was talk about a margin call on that point. Now, I'm sure they worked with their guy and got around it. But that's the type of margin call you do not want to get. And I think we just now need to move into our picks for the week. But before we do that, our lawyers have been getting on us, and they really just want to make us say we really need to give a disclaimer before we say this. So this is just lawyer talk here, so we don't get sued. This upcoming segment is for entertainment purposes only. Everyone on this show, i.e., me, Michael Tanner, invests his money for our own account, and we don't manage any outside money. We do not give investment advice, and we do not offer securities or have ever been involved on the regulatory side of the industry. Investment is risky, and you can lose your entire principal. With that being said, Stu, what's your picks for the week?
Well, as far as my disclaimer, just what you said. Okay.
It covers everybody.
Cool. I'm in. I have two, Michael. I'm going to stay with LNG. I did really well. Right now up. It's 1.63 and looks like doing well. Apache. I'm still going to hang in there with Apache this week. And the reason the technicals have come down a bit, and I think you've headed before, you and I talked about it last week, for long term, it looks like it could go Harry Carry, but for right now, I'm playing in and out. So. Yeah,
no, I think I don't know necessarily if Apache's going to be there long term, but I like you. I like getting long here. If you talk about a fake portfolio here, let's just say $10,000. You never want to allocate more than 10%. I mean, really, you talk to some people, they won't even go more than 1% of. But if you're only trading with, say, $10,000, you don't want to go more than 10%, so $1,000. So we'll pick you up 90 shares at about 1069. See what happens. You're like you said, you're staying with LNG, which I like. You're exiting GeoPark, which you said was even, correct?
Yeah, it was up, down, and that was it.
Well, that's a win. And really, if you actually do get into this, do get into actually trading some stocks and options, if you break even on a trade, you got to count that as a win, and you'll start seeing your winning percentage drastically increase. Because if you're not logging each trade you do, you're doing it wrong. So if you're just wildly trading and you're not logging, this is what I'm doing, this is why I got into this trade, and this is what I'm looking for to exit, you're doing it wrong. And so when you go back and because then you can calculate a winning percentage. What's my winning percentage on this? And if you start counting break evens as wins, you're going to see your winning percentage go from, I've seen it go from 30, 40% to people all the way up to 60%. And all of a sudden the psychological effect comes in. You think you're winning more, and it just compounds on itself.
You bet. Hey, Michael, on that one, though, I'm going to be looking at it hard because it is in the South American Colombia area, and Colombia is going nutty. That $4 billion they've got for E&P companies down there is just phenomenal. 10x. You and I had talked to Miguel, the president, and he's also got product going in there. And
well, they said the international game is going nuts.
Absolutely. And so also the folks over at JCA as well are off into Columbia. So I'm really looking at Columbia as a anybody servicing in the oil and gas space in Columbia is normally something I'll take a look at.
You heard it here first on the 360 Digital Bell podcast. Stu is looking at Columbia. But no, so we're going to go and start keeping track of our trades because we need to. So we're going to pick up, like I said, 90 shares at about 1069 for Stu. We'll keep track. He'll let you know when he decides to exit. For me, I was diving into low debt companies today. That's really what I was looking for. And honestly, the one I came across, Bonanza Creek, I really, really like the way their chart looks. The problem is their options table looks weak. I'm a big options guy. If I'm going to trade stocks, it's going to be in the form of options. I don't necessarily like to just buy shares of a company because that's just, you're exposing yourself and you have to put up all the capital yourself. Options allow you to leverage and margin up. The problem is I like Bonanza Creek from a price action standpoint, which is generally how I trade stocks. I trade futures from a price action, from futures I trade from an order flow standpoint. Stocks and equities, I generally stick to a price action just because of the way the mechanics of the way that both of those asset classes work. But Bonanza Creek, the option tables looks weak. So I'm just going to get in, again, assuming a $10,000 portfolio. I'm not going to allocate more than about 10%. I also forgot to mention, we're going to use Robinhood as our fake broker. So assuming we don't get hacked and we can get in and out of our trades, we got no fees. But if Robinhood ever wants to be a sponsor of the podcast, I will cut that part out and put in a shameless plug for Robinhood. But assuming they don't, and assuming we don't get hacked through Robinhood, we're just going to say we have no fees as well. So I don't want people getting technical.
What's the ticker for Bonanza?
BCEI. They're in a real just choppy upflow right now. I'm going to get in just market open, 65 shares at 14.89. So a little less allocation of shares, but just because I'm paying a little more of a premium than Stu. I mean, it's really why I like them. Or the reason why I like them is their debt to equity. I think their market cap is slim, and they're in the DJ Basin, which if you want to talk about another nugget we learned from Phil, this is why I love this job, Stu, because we get to sit on these interviews that there's just so many little nuggets. And the one nugget that I heard was that the best performing field, in Sproul's opinion, so this is just Sproul's opinion, was the DJ. That's another nugget I took out of there, was that they loved the DJ moving forward. Well, Bonanza Creek, all they produce is in the DJ. So it's just another thing when I was looking at this, I was like, I like the price action chart. I love the data I'm hearing about what the Wattenberg's coming out. They had they had a weak earnings report and their stock didn't drop, which means I think analysts are bullish. I see a couple analysts have them at $34. I mean, we're buying at $14.89. Like, this could be a very nice buy and hold for my portfolio. We'll see how early I decide to exit. If it's anything like, if I haven't learned anything from my XOP days, I need to. But
Michael, the techs are only looking at them as a one-day buy. For a week, they're looking at a stronger sell. The other thing that we heard on that interview was that the political unrest or issues in the DJ may also impact on DJ production as well. So something to keep an eye on there.
Oh yeah, and and to be honest, how I look at trades, if I don't have any negatives for a trade I get into, it creeps me out because it means I'm not doing enough research. Yes, if you want to be bearish on Bonanza Creek, that's exactly what you should be saying. While their earnings came out, it's weak. Analysts have sort of, they're still net bullish, but analysts have switched from mostly bullish to about a 60-40 swap. That they're. The DJ does have some political unrest. I'm looking, and that obviously, where it doesn't matter how lucrative of an oil field you have and how much economical production you have, one swoop of the pen from Jared Polis and boom, no more oil production. So yeah, that's your bearish, but I'm gonna swing bullish. No, I'm serious. If you are evaluating a trade and you can't come up with any negative, again, much like if you're not doing a trading log, you're doing it wrong. You're doing it wrong. If there's no negatives, you're going with, and that's the exact negative case for Bonanza Creek. So, you got to keep you guys honest here because that's what we do. Again, remember this segment, it's just entertainment purposes only. We're not actually buying any of these stocks, but we are going to keep track of our fake portfolio. We'll call it the 360 Digital Bell fake portfolio. We got to come up with some name. All these hedge funds have sweet names like Ray Dalio, his Bridgewater, they call it the Alpha Fund. Warren Buffett's got they call it the Victory Fund. We'll have to come up with a fun name.
MT Hart.
I love it, MT Hart. Anything more on the picks before we give Steven and Nick a call?
Tanner rants.
Oh, I like that. I like that. We'll just call it like the. I like it. I like it. But we got Steven and Nick hot on the line. As always, high level stuff from both Nick and Steven. Again, we appreciate both of them joining us. It's been a wild episode today. I appreciate you guys tuning in, but we're going to go and let you guys get back to work. Thank you for checking out the 360 digital closing bell here on Oil and Gas 360. We'll see you guys this afternoon for the digital ticker.